In this video, we are going to break down what a HELOC is and answer all your biggest questions about what a HELOC is so that you can confidently unlock the hidden cash in your house without accidentally falling into a massive debt trap. Let's get into it. All right, so here's a quick overview of what we'll cover today. First, we'll define exactly what a HELOC is and how the basic math works. Next, we'll look at the specific timeline of how you actually borrow and pay back the money, because it is broken into two very distinct phases. Then we'll dive into the fees, the financial jargon, and the real-world risks involved, so you have the complete picture before you talk to a bank. The basics, decoding the HELOC. Okay, now let's start with the big acronym. HELOC stands for Home Equity Line of Credit. But what does that actually mean for you? Well, to understand it, we first have to understand equity. Equity is simply the current market value of your home minus whatever you still owe on your mortgage. If your house is worth $500,000 and you owe $300,000 on your mortgage, you have $200,000 in equity. You can think of equity as the portion of the house that you actually own free and clear. So a HELOC is a way to borrow money against that equity. It essentially turns your house into a giant brick and mortar credit card. Instead of getting a single big lump sum of cash like you would with a traditional home equity loan, a HELOC gives you a maximum credit limit. You can borrow against it, pay it back, and borrow again, just like swiping a credit card. You only pay interest on the money you actually use, not the total limit. Yeah, it sounds pretty great, right? You've got this pool of cash just sitting there for a kitchen remodel, consolidating high interest credit card debt, or paying for emergency repairs. But knowing the definition is just step one. Stick around because understanding the strict timeline of a HELOC is where most people get seriously tripped up, and we're going to cover that right now. The two phases, draw period versus repayment period. All right, so the mechanics of the HELOC are split into two very different timeframes. First, you have the draw period. This is usually the first 10 years of the loan. During the draw period, the credit line is open. You can pull money out whenever you want using special checks or a debit card tied to the account. And here is the kicker. During this time, your minimum monthly payments are usually interest only. That means you aren't actually paying down the principal balance of what you borrowed unless you choose to pay extra. It keeps your monthly payment super low, which feels great at the time. But then the draw period ends and you enter the repayment period. This phase usually lasts 10 to 20 years. The credit window slams shut. You can't borrow another dime. And worse, your payments are now fully amortized, which is just a fancy banking word meaning your monthly payment is recalculated to include both the principal and the interest, so the entire balance reaches zero by the end of the term. Because you're suddenly paying back the principal too, your monthly payment is going to shoot up. It can literally double or triple overnight. This payment shock is a massive frustration and fear for a lot of homeowners who aren't prepared for it. By the way, if you're getting value out of this video, hit like, subscribe, and tap the notification bell to get more valuable content like this. So now that you know how the timeline works, we really need to look at the sneaky hidden costs and the absolute worst case scenarios, which I'll break down for you next. The fine print, rates, LTV, and risks. Let's talk about the catch. You've probably heard the term APR, or annual percentage rate. Unlike most traditional mortgages that have a fixed, predictable rate, almost all HELOCs have a variable APR. This means your interest rate fluctuates based on the overall economy. If the Federal Reserve raises interest rates, your HELOC payment goes up. You have to ask yourself if your budget can handle an unexpected hike in your monthly bill. Also, banks love to throw around acronyms like LTV. LTV stands for Loan to Value Ratio. It's just a simple math formula lenders use to see how risky you are. Most banks will only let your total debt, meaning your primary mortgage plus your new HELOC, equal about 80 to 85% of your home's total value. They won't let you drain every single penny of equity because they need a safety cushion in case housing prices drop. And speaking of dropping housing prices, let's look at all the angles here. The biggest, most terrifying risk of the HELOC is that your loan is secured by your home. If you lose your job, max out your HELOC to buy a sports car, and can't make the payments, the bank can foreclose on you. You could literally lose your house. On the flip side, if you use a HELOC smartly to renovate your kitchen, which increases the value of your home, it can be a phenomenal tool to build even more wealth. Just don't treat your home equity like a Vegas ATM. To sum everything up, today we covered exactly what a home equity line of credit is. We learned that it acts like a revolving credit card tied to your home's equity. We broke down the 10-year interest-only draw period and the longer repayment period where your payments can spike. And we looked at the real risks of variable interest rates and potential foreclosure. For you, this means you now have the knowledge to look at a HELOC not just as free money, but as a powerful, flexible financial tool that demands strict budgeting and a solid plan to pay it back. Quick disclaimer, I am not your personal financial advisor or attorney, and this video is for educational purposes only. So always consult with a professional before making major financial decisions regarding your home. If you want to keep learning, check out this video next. Thanks for watching, and I'll see you in the next video.